something that we're real proud about. So what I'm going to let these ladies do is go over our restaurant credit presentation. And if you guys have any questions, just let us know at the end. Thank you.
Hello, I'm Destiny Mitchell. It's a pleasure to be here with you all today. I've been with the company for 6 years as well. When she asked me to talk about credit, I'm like, me? Talk about credit? I guess being in the banking field, I learned a lot because I haven't always had good credit. So just working in a financial institution, it just helped me a lot, talking with different people and resources. And I feel like sometimes as women, we miss that educational piece. So I'm going to share some topics with you all today about credit basics. And then we'll provide some tips on how to establish, improve, and manage your credit. Well, they're going to talk about it. All right, first up is credit basics. What is credit? Credit lets you make purchases by agreeing to repay those funds later. Your credit limit, interest rate, and payment schedule are set by your lender. Your credit history reflects your ability to follow your lender's terms. Borrowing responsibly can help you build the life you've pictured for yourself. Credit plays a major role in your financial life, from securing loans, to renting a place, to live, and even landing a job. Having good credit can open doors to auto loans, mortgages, funds for education, and more. When you understand credit, you're able to use it effectively to reach your goals. We also have, if you want to look at some other credit options, you can go to wellsfargo.com. In the middle of the page, and there's some information there about borrowing your credit as well. What is a credit report? A credit report is a detailed list of your credit history based on information provided by your lenders. Your credit accounts, your payment history, and the details of how you manage each account. Your credit report gives potential leaders important tidbits about you. Specifically, a credit report contains information about you, your name, address, social security number, date of birth. Those are the things that help identify you. Public record information. In this area, you will find any information that is listed about you in the records of local, state, and federal courts. Collection agency account information, which is if you fail to pay back any creditors, they might hire a collection agency to contact you. Collection agency is typically a company that specializes in collecting money to pay your debts. Your credit history is a list of all the places where you have credit or used to have credit. They are called your accounts. Inquiries. This is a list of the companies that have requested a copy of your credit report for their review. Credit score. A credit score is a numerical rating used by lenders in the loan approval decision process. Lenders always want to know the credit history of people who ask them for credit cards and loans. To find out, they turn to the credit bureaus. The most important and the three largest credit bureaus in the United States are Equifax, Experian, and TransUnion. Credit bureaus keep track of consumers' credit history information, like how many credit cards that you may have, how much you owe, whether you pay your bills on time, where you work, and how long you have worked there. Your credit score makes up 35%, and how well you pay other people back is 35% of your credit score. A credit score indicates how reliable you have been at paying back your debts. The credit bureaus analyze your entire credit history and generates a score, usually ranging anywhere from 300 to 850. And it varies from bureau to bureau. So if you have a 760 or higher credit score, that's considered excellent. 700 to 759 is good. 621 to 699 is fair. 620 and below is poor. And no credit score is also there. Your credit score impacts you in a lot of different ways. It can keep you from getting a credit card, purchasing a home, whether a landlord will even rent you an apartment. The interest rate lenders are likely to offer you, the amount of your insurance premiums, your ability to borrow money, and whether you can even get service from a utility company. How you can impact your score. 6 things that can improve your credit score would be 1, pay your bills on time. 2, keep credit card balances within 70% of your spending limit. Only apply for and open new credit accounts when you actually need them. Pay down debt to reduce your debt-to-income ratio. Establish and maintain a good credit history and have a mix of revolving credit. A few things that you would like to avoid, and they can also lower your credit score, would be paying your bills late, having credit card balances near your maximum spending limit, applying for new credit cards frequently, whether you need them or not, exceeding your credit card spending limit. Please note that while not something you can always proactively impact, it is also important to understand that good credit takes time to establish. If you are new to credit, or if your credit file has not had any activity for some time, you may have built up enough credit file at the credit bureau to positively impact your score. What lenders look for. Credit history. When lenders evaluate a loan application, they look for stability in your credit history. For example, how long have you lived at your current address? How long you have been in your current job? Whether you have a good record of paying your bills on time and in full. If you want a loan for your business, the lender may consider your experience and track record in your business and industry to evaluate how trustworthy you are to repay. Capacity. Capacity refers to considering your other debts and expenses when determining your ability to repay the loan. Creditors evaluate your debt-to-income ratio, that is, how much you owe compared to how much you earn. The lower your ratio, the more confident creditors will be in your capacity to repay the money you borrow. Capital. That refers to your net worth. The value of your assets minus your liabilities. In simple terms, how much you own minus how much you owe. Collateral, that's used when applying for secured loans. Collateral refers to any asset of a borrower, for example, a home, that a lender has a right to take ownership of and use to pay the debt if the borrower is unable to make the loan payments as agreed. And last, conditions. Lenders consider a number of outside circumstances that may affect the borrower's financial situation and ability to repay. For example, what's happening in the local economy. If the borrower is a business, the lender may evaluate the financial health of the borrower's industry, their local market, and competition. So the first part that I summed up pretty much is credit basis. I'm going to turn it over to Jennifer Foley, who's going to talk more about the debt-to-income ratio.
Hi, I'm Jennifer Foley. I'm new to Wells Fargo, but I used to be in the automotive business, so a lot of this is kind of goes hand in hand. So my topic is the debt-to-income ratio. So when you're going to buy a car, you kind of need to know if you can afford it. So debt-to-income ratio is basically it's a little bit of math involved. Step 1, you're going to calculate your monthly income, and you use your income before taxes. Step 2, you're going to add up your monthly expenses, which may include your rent, your mortgage, any alimony or child support, student auto, other loans, credit card payments, and any other debt that you owe. And then step number 3, determine your debt-to-income ratio. You divide your monthly expenses by your pre-tax income. So as a lender, there are a lot of different things that we look for when considering your debt-to-income ratio. Timing, you pay your bills on time. Checking account, how you've used your checking account. Do you overdraft it? Do you use it like you're supposed to? How much do you make? What's your paycheck? Credit cards, how are you using them? Are you keeping them maxed out, or are you using them wisely? Your purchases and bills, how are you paying? Did you go to the doctor and not pay that bill? How are you paying bills that you owe? What does your savings account look like? And do you save money for any unexpected expenses and things such as that? So an ideal debt-to-income ratio would be 35% or less. That gives a lot of room to make purchases such as autos, so that you can keep your debt ratio lower than your income. And that's all I have for debt income ratio. So Maria's going to talk about establishing credit, or reestablishing credit.
All right. Hi, my name is Maria Dickerson. I'm a personal banker at Wells Fargo. I just wanted to add just a little tidbit when you talk about credit. Being as how it's a women's empowerment, generally women make 20% less than men. So that means our credit needs to be top notch because we're already working against the group. So we need to make our money work more for us. And with that being said, we'll go ahead and go to improving your credit. Here's ways that you can raise your credit score, be responsible, and always pay on time. Paying on time accumulates for 35% of your overall credit score. If you know that you can't pay on time, contact your lenders. More so than not, they'll work with you. They don't want you to go into foreclosure. They don't want to repossess your car. They want to help you out. So contact them. Try to pay more than the minimum amount each month and avoid opening too much lines of credit. It is good to have a variety of credit, but try to avoid having too much. A lot of people always come in and they say, and they'll sit down and they'll say, and I ask them, what does your credit score look like? And they say, I don't know. They know that they haven't paid everything on time, so they just automatically assume that their credit is bad. And that's not always necessarily the case. So I always suggest that they go to annualcreditreport.com. Free website. It gives you all the 3 credit bureaus' reports and their details. It also allows you to dispute anything that's not accurate. Take advantage of it. It says, what can you do? What can improving your score do? If you want, good credit generally means lower interest rates. On a loan of $15,000 at 15%, it's going to cost you $427, and that's for poor credit. For excellent credit, 5% that same loan is going to cost you $352 a month. I also did another calculation. Let's say you went out to go buy a car for $25,000. Excellent credit. Let's say they offer you a 3% rate. That loan is going to cost you over the term $27,000.26. If your credit score is less than 620, that same loan is going to cost you $34,992. There's a big difference. Big difference. Let's see. And then, getting ready to borrow. You need to identify what your short-term and long-term financial goals are, writing them down. Write a to-do list. I do a to-do list for just about everything I do. And then evaluating if you're ready for a major purchase. Do you know what your credit score is? Have you worked on it? Have you improved it? Are you at a credit score that you can get that acceptable rate? And determine how much you need to borrow and review your credit options. You also can explore your credit choices depending upon what it is that you're trying to purchase, whether it be a car, a house, a credit card, a student loan. And then we also have different resources through Wells Fargo that you can just go online just to research at www.wellsfargo.com/smartcredit. And that's about it. It is.
All right, so these 3 ladies talked about a lot of great information today, Destiny talked about credit basis, Jennifer talked about debt to income ratio, and Maria discussed about improving credit. So credit is very important. You know, even for any age group, credit is important. Whether it's rebuilding, establishing, increasing your credit, all of those aspects are important. So I encourage you guys to take interest in your credit. Any questions? I would do it annually, just once per year, just so that way, you know, you can see what's on there, what's changed.
Repeat the question so that we can hear what the question was and they can answer.
Okay, she asked how many times is it okay to pull your credit? And I was explaining to her, just, you know, once a year is good, so that way you can see what's on there, what's come off, and see if any changes have occurred, has your score increased, so that's a good idea to do.
I also want to reiterate that anytime you pull your credit and you're denied credit, at that point in time, you're also allowed to get a credit report. Generally, after that first annual credit report is issued, that's for free, there's a charge. But anytime that you decline credit, you can get a report for free, because they have to inform you why you were declined.
You can also get your report from all three agencies, so you can get one quarter, and the other one another quarter. You can have it multiple times through the year.
Yes. Yeah, and then you can all do, when you do the annual credit, they'll pull all three as well. Yes.
Would that hurt the credit score that point at 3 different times?
Well, that's why I would just pull it that one time, get it from all three credit bureaus once per year with the annual credit report. What Maria was mentioning was, let's say you apply for something and you want to know, hey, you know, I was declined, I don't know why. So then you have the right to pull that and figure out what's going on with your credit at that time. Yes.
So when you have a credit card and then they give you an app and they tell you that you can look at your credit, are you pulling your record every time they send you? Oh, okay.
No, it's not a hard pull when you're doing that. That's just, and then also that's not always accurate because that's like an idea of what it might be, and then it's different with each credit bureau as well.
I just thought of one thing. Also, another way, if you know that you're having credit problems and you want to reestablish your credit, there are secured products. Generally, they'll require an initial deposit of whether it be $300, $500, but they're a really good tool to help you rebuild your credit. I've seen people raise their credits over 100 points within 6 months. So, you know, just keep that in mind. There are things out there to help you rebuild it. It's going to take time once it's done, unfortunately, but just because it's bad, it doesn't have to stay bad.
And one more thing to add from Maria. I know, I'm sure everybody in here likes to shop, because I like to shop too. So, you know, every store you go in, they're like, hey, do you want to save 5%, 10%, 15%? Right. No. You know, it's hard to turn that temptation down, but as far as with products, when we talk about credit cards, it's better to find a credit card from a lender that gives you good rewards. If rewards, whether it's cash back or rewards points, it's better to get something like that instead of getting JCPenney, Bells, Old Navy, and have, you know, just racking up the credit cards. Just have a couple credit cards that you know, and then the interest rates can be higher as well too. You know, after the introductory rate of 12 months, and now you're not getting that % off every time you go on Old Navy or whichever store it is.
So accounts don't normally just close by themselves. Even though they may be being dormant, they're still there. So you can say, say, well, I've had this credit card, I don't use it, I'm thinking it's closed out. No, it's still there. It's better to keep those credit cards or like whatever your credit is open than to close it, because if you close it, it's going to have a negative impact on your credit.
Okay, so it's basically you haven't used it for a while. So I would just call them and see what do you have to do. Maybe you have to use it one time and that'll be good for like the next 5 years, of keeping it open.
Because it's still going to have an impact on your credit. It's going to show that the account is closed. And what they look at is your longevity of your credit. So the longer that you have credit and that it stays in good standing, the better your credit score is going to be. Because they want to see that you have an established credit history, not something that was just opened up 6 months ago. They want to see have you had something that was opened up 10, 15 years ago. Is it still current? Is it still open? Is it